Hello, everybody. Hope you're having a nice day. I want to talk about a way to come up with a trading idea. Actually, there's a couple ways here, and it is just so you know, it's after the close on November 1st, and I'm looking at this Align technology. Now, the best traders don't come into the market with these preconceived notions. And I mean, I know I got to self promote a little bit, but I worked at some of the best funds in the in the industry. Worked for Steve Cohen, Mario Gabelli, said trader at a bunch of different places. So I've been around the block a few times, and in the retail world, it really amazes me how many misconceptions there are about what market makers are, what dark pools are, algorithms, hedge funds. But that's a different conversation. And actually, at Stock Market Jobber, we have a lesson that covers all that. But anyway, what is a support level? We can see support levels in pretty much any market. A support level is a level where there is enough demand to fulfill, or I should say, to absorb all of the supply. When a market's moving lower, there's not enough buyers or demands. So the sellers are forced to offer their shares at a discount. And if they want to entice buyers to come in off to the market off the sidelines. So that forces the market into a downtrend. When we get to support, the tide turns. All of a sudden, for whatever reason, that's where the buyers decide to come out of the woodwork. And now the sellers could sell all they want to, and the market's not out of equilibrium anymore. And a lot of times, when we get to support, we rally off of it. This is a very common thing, and it's a very low risk thing to base some of your trading on. You got a lot of buyers at a support level. That's what support is. Some of the buyers start to look around and they sense, oh, gee, there's other buyers coming into the market. The sellers are going to go to whoever is going to pay the highest price. So this guy over here is bidding 199. I'm going to bid 200. Someone else sees that and they're like, you know what? I'm going to bid 201. And you get this buyers trying to outbid each other. You get this bidding war, and it starts a snowball effect. All right. So 1.1, sometimes we get to support, we rally. Point two, we get support at levels that were support before. This is another very common thing, and this is what's going on now with Align technology. I'll put that down there so people know what I'm talking about. There are people who sold back here because they were afraid the market was trending lower. Then all of a sudden the stock blasts off. Well, guess what? A lot of them tell themselves, I want to buy my shares back. I made a mistake, but I'm only going to do it if I can get them at the same price I sold them at. So when the price finally gets back down to where they sold, if there's enough remorseful sellers becoming or placing buy orders, what was support becomes support again. Remorseful sellers trying to buy their shares back. So this is why a lot of times you get these huge sell-offs, and where do they come to an end, or a pause at least? A level that had been support before. Trading, so much of trading is understanding where the important price levels are. In my personal opinion, as someone who's been doing this for 30 years, it's if you don't know where the levels are, you might as well. It's like driving into a town without a GPS and a map. If you've never been there before, you're not going to be able to figure your way around the town. So anyway, now a lot of these buyers are kind of looking out for each other, and they're like wondering, hey, if someone else starts to pay a higher price, I may have to pay a higher price too. So when things get to support, they tend to rally. There's a good chance that that happens here. Another thing to lag it here is we have a gap. When a market closes at one price and opens at the next price are down, and there's all these levels we didn't trade at, we call that a gap for an obvious reason. It shows up on the chart and it looks like a gap. So on this day we close there, the next day we close there. No significant trading in between here. None during open hours. Maybe there was some when the market was closed, but very, very light. So a lot of times when we get resistance is because we have remorseful buyers trying to get out of their positions. They bought and then the stock goes lower and they tell themselves, I made a mistake. If this gets back to my level, I'm going to get out. Buyer's remorse. And I'm just going to kind of go over to another chart here where you can see this. An excellent example of this is the technology sector ETF. Going back towards in the beginning of 2022, see support becomes resistance. Support becomes resistance. People buy, price goes lower. A lot of them say, if it gets back to my price, I'm going to get out at break even. So support can turn into resistance. Support can turn into resistance. Understanding that certain price levels are more important than others is essential to becoming a good trader, in my opinion. So now, why did I bring that up? Well, if the market just broke through all these levels or blasted through them with there was no trading, there was no one who bought because it didn't trade there. So you're not going to have remorseful buyers trying to sell on the way up. So if this does start to reverse, the buyers are going to come into the market. They're not going to have an easy time finding sellers. So this can make a pretty rapid move back to there. This is where my sell target would be because right at this last level of support, that's where there's a good chance there's going to be resistance. All right. Two more things. Very oversold. As a matter of fact, this thing is the most oversold it's been in 20 years. Oversold means it's been really beaten down below its typical or normal trading range. These conditions are going to draw buyers into the market because things that get too far away from their average tend to reverse. And a lot of Wall Street or institutional trade strategies are based on this concept of reversion to the mean. So now, last thing I want to show you why I think this looks like there's a good chance that this stock rallies is the volume. Now, I don't generally look at volume too much. I think I mean, I could go on and on for hours about it, but I look for capitulations and I look to see if there's enough liquidity. Like, for example, if I want to trade a stock and I see it only trades 1,000 shares a day, it's like you can't really trade it. But this is the capitulation. You see how here, you know what I'm going to do? I'm going to get rid of these things so it's easier to read. All right. Notice these big spikes in volume. And I'm just going to go back to the beginning of the year, just year to date to make it easy. Big spike in volume right here. What is this? This is a capitulation to the upside. See how it was the very hot top day up here, right? What happens is there are people who are watching this thing go higher. They want to buy it. They hear their friends talking about it, you know, how their friends are making money. They get frustrated. They're like, they keep thinking, oh, you know, I think it's going to come back in and I could buy it at a lower price. They keep watching it go higher and higher and higher. Finally, they're like, you know what? Like say you're an institutional trader and you got a big order, like 200,000 shares. You come in here, you buy 20,000, goes up a little more, you buy 20 more thousand, you still got 160,000 to buy, and you start thinking, you know, I'm going to back up a little bit. Maybe it comes back down and I could buy it at a better price. But it goes up and you buy another 20,000. It goes up again and again. Finally, you say, you know what? This sucks. I got 60,000. I got 140 left. I'm just going to tell my broker, just go out there and buy it. I don't care. Pay any price. Just forget it. It's a capitulation to the upside. So you get this panicked buying and it drives the thing up. Now, guess what? When there are sellers who are like, hey, this stock has moved up a lot. I think there's a chance it comes back in. I think it's going to go lower. So I'm going to get there and sell. Well, there's a hard time finding buyers because the buyers threw in the towel. It's like, hey, you're a day late and $1 short. You know, you should have been here yesterday or 2 days ago. Anyway, the stock goes from 356 down to 300. So that's a huge move. Same thing happened here. A lot of times capitulation volumes are way higher than this, but this just shows the principle. People buy it. There's panicked buying. There must have been some news. Then the market runs out of buyers because the buyers have capitulated. The buyers are just like, whatever. I'm going to, you know, think of the top of a bubble. Beanie Babies bubble. You know, what were Beanie Babies going for? 5,000. It's just a panic. It's like, oh, I got to buy it. I got to buy it. I got to buy it. I don't want to miss it. So you get this big spike in volume. It's the opposite of, well, actually, it's the same thing as what we just talked about before. Now, sorry. Here's the opposite on the sell side. You get these traders that want to sell. They kind of pull back. You know, if you're an institutional trader like I was and you have a big order, say you got an order to sell 1 million shares of this thing. Well, it only trades 1.7 million shares a day. So that's kind of a difficult order. So you got to kind of play games, right? You can't just throw the holding out on the market at once because you'll spook the market. So it's like, all right, I got 1 million shares to sell. I just sold 50,000. I'm going to back off for a few days because I think it's going to go higher. Oh, damn. All right. I'm going to sell another 50,000. Damn. It's going lower. I'm going to just wait. It's going lower again. I'm going to sell another 50,000. And it goes lower. Finally, it's just, you get so sick of watching it. You tell your broker, hey, Just go out and sell this damn thing. Make it go away. I don't care what price I get. Make it go away is a very common expression in the Wall Street community. So you can see, or the institutional community, after a few days, there's been a ton of volume. So now, if people that want to buy this start to look at the news and start to think, gee, that news was bad, but it's not as bad as they or they thought it was. So I'm going to come in and start buying. They're going to have a hell of a time finding sellers. So they're going to have to be willing to pay a premium. Maybe someone comes in to buy 100,000 shares at 200, and there's a seller that'll say, "Hey, I'll sell you at 10,000 at 200, but you want to buy another 10,000? You got to go up to 215." No other sellers around. You snooze, you lose. I'm the best price in town. Take it or leave it, right? And then the buyers are forced to pay these higher prices because here we gap down. So there's not going to be a lot of investors who bought in there who are looking to sell on the way back up to get out of break even. All right, so that's it. We talk about at Stock Market Jobber important price levels, important trends, momentum, and psychology. And that's what you got to focus on. Forget all this dumb stuff. I'll even just say this, like dumbass stuff like Gann theory and Elliott wave and Fibonacci. In the institutional trading world, no one uses that stuff. All right. Thanks, everybody. I hope that helps, and I will see you soon.